Here's a story of another positive experience, smooth ride, another private loan that went basically exactly how it was supposed to go. We did have some issues to deal with at the beginning to get it going, to make sure that we got it going the right way, and we did actually have something at the end that we had to adjust to. But look at the performance of this: $250,000. Imagine this was your money. $250,000 goes out at 11% interest, and for 12 months, all you do is sit back and on the 15th of every month, collect a check. That's exactly how this went. And there's a stigma out there about private mortgages that, they're risky and that there's going to be problems and whatnot. And yes, I acknowledge there are problems with every single private loan. That's why they're private. And that's why banks don't say yes to them. But you can mitigate the risk if you set it up properly. I'm going to show you how we did this to get this result. But look at this result, guys. Imagine you had $250,000. You put it out into an investment paying 11% fixed every month, same payment. It's like being a landlord without the headaches of being a landlord. So you can see 12 months of interest, 2291.87 every month, like clockwork. Let's go to the next slide. Now, there was a challenge here because we expected to refinance this person back to a bank in 12 months. And as we were getting to the later stages of that 12-month loan, in month 9, 10, we started to realize that there was a problem. The value of the property had dropped. And so the original refinance plan had to be adjusted. Now, if you're a private lender and you just sit back and let the borrower try to deal with this alone, you might end up in a problem. Instead, what we did is we got involved, connected them to a good broker who could handle this type of refinance, and they went out and did that. We ended up needing an extra 30 days, so we extended the loan for an extra 30 days, and in 19 days, it was refinanced to a bank. We got all of our principal back, including interest right up to the day that it closed. So let's look at the performance overall. You can see the outcome. So you get 100% of your principal returned in 12 months and 19 days, or 14 days, sorry. Total interest earned on 250,000, $29,006.85. That's an annualized return of 11%. Everything was done exactly the way it needed to go. I love to get your feedback, but that's a pretty impressive ride, no?
I'm used to it at this point, but yes, it is impressive.
Yeah. And Jeff, we had two investors in this deal?
Yes, only two investors in this deal. Yeah.
So you got 121,000. It just goes to show you, and because of the way we do things with a syndication model, you don't have to fund the whole $250,000. That's the idea. That's why I wanted to ask you. So you got two investors in here, one for 121,000, one for 129,000. You can see exactly what each of them earned, and they basically just share the loan. It's a really neat model that allows anybody to play at different levels. You could have $50,000 and you could get involved here. You could have the whole 250, or like in this case, you could have basically half and half. Okay. Let's talk about how we structured this loan, though, because when it came in, this is always the problem: is people look at this. I'm sure potential investors, people who want to get involved, and they say, "Wow, like it can't be this easy." Well, it's not. It's not this easy. Every single private mortgage application that comes in has a problem, or at least one, if not multiple problems. But it's not about looking for an application that doesn't have a problem. It's looking for an application where the problems are fixable. And that's the difference. So, and so that everybody knows, it's about 8 out of 10 that we decline, right? So 8 out of 10 applications that come in are not fixable. And the answer is that that person should sell the house. They've kind of reached the end. They can no longer sustain being a homeowner, and they should sell the property, because that's always the that's like, there's two exit strategies possible in any private loan. It's either refinance back to a bank or sell. And so the fail-safe is always selling. And we have to have the ability to say to people, look, I don't think your circumstances are fixable. And we're not just going to take 11% from you for a year plus fees and everything else, just so you're here again next year. We're only going to do it if we can fix it. If we can fix your issues and get you back to a bank, at 4 or 5%, Well, then we've actually done something good and it's a win-win for both sides. The investor makes 11%. It's manageable for a year. It's sustainable for a year. And we're able to get you back into that, 4 or 5 bankable rate range where you can continue as a homeowner building equity and whatnot. So if you think about it from the borrower's perspective, it's like they're just they're like pausing, right? It's not about, whether they can get cheap money right now. It's whether they can hang on to the house. And if we can help them, yes, it costs money, but it's manageable for a short period of time. We can get them back. So I want to look at what it looked like when it came in, right? And how we structured it to make sure that it could actually work. So, this slide's always interesting. Would you fund this borrower? It's like if all you knew was that uh, you got a $270,000 request, right? So that's what the application was asking for. We only lent 250, and I'll explain why. But the initial ask was 270,000, and you've got one borrower with $140,000 salary. You've got the other borrower with a $72,000 pension. So you have like $210,000 in income. The credit is good, right? Credit is mid 700s. Um, but your appraisal comes in lower than you expect. The refinance plan becomes uncertain. The LTV jumped from loan to value, meaning when they applied, they were looking for 65% of the value. But when we got the appraisal, the value came down so much that the loan to value was now 75%. And we were in a declining market. So if I told you all these things, right? If I told you that the appraisal is going to come in lower than you expect, the refinance plan isn't going to work the way we initially think, the loan to value is going to jump by 10% from what it was when they first applied, the market is declining and depreciating in values, and you're being asked to lend $270,000, would you say yes or no? And the answer should be, I wouldn't say yes or no. I'd say, tell me more. Right. So let's look at how we looked at this. Because, the reason we put that slide up there is because people get scared. People see the application, and again, you got to have that mental framework to say, I know there's going to be problems. Like, you have to have the expectation there's going to be problems. It's a discovery. When you're looking at an application, you're not looking for its strength right off the hop. You're looking for to discover where the problems are and whether they're fixable. Because a lot of deals look good at the start, and a lot of deals look bad at the start. You can't, if you judge them in 5 minutes without really looking deeply, you're going to probably approve some that you shouldn't, and you're going to miss some good ones along the way. So there is work to be done here. So you have to consider what's going to change. You have to be a forward thinker, right? And you have to consider the collateral, the equity buffer, the exit certainty. These are all very, very key things we're going to look at. I mean, you guys know our 3 big pillars. We look at the collateral first, then we look at, can the borrower actually make the payments for 12 months? And then C, can they get out? Can they get back to a bank inside of 12 months? And to a lesser degree, what about if it took 12 to 24 months? I mean, that's possible too. And we do have provisions for how a 12-month loan can become a 24-month loan, but that's as far as we go, because private mortgages should be short term, not long term. Okay, so we're going to adjust the structure as we go based on what we find out in the application. Let's take a look at the next slide. So, at first glance, when this application comes in, here's what we're seeing. First mortgage is already in place for $845,000. There's a second mortgage in place for $199,000. Okay, and they're requesting a $270,000 second mortgage to replace the existing second mortgage for $199,000. So now they're increasing by about $70,000. They have $212,000 of combined income, great credit. Okay. And the purpose is to refinance. And what they're trying to do is consolidate some consumer debts. Those consumer debts, if you're wondering, why can't this person go to the bank with good income and good credit? It's because their debt ratios were too high. So the bank has very set guidelines. It basically says, in a nutshell, that you can only spend this much of your gross income on your mortgage, property taxes, and heat. And then in addition to that, you can only spend this much, which is a little bit more. I think it's 35% of the gross income that you can spend on your mortgage payment, your property taxes, and your heat. Those are bank guidelines, generally speaking. Then if you add in your consumer debts, the total of the minimum payments to all your consumer debts, loans, lines of credit, leases, credit cards, plus your mortgage payment, your property taxes, and your heat cannot exceed 42% of your gross income. So in this case, you get someone who's got good credit. Why do they have good credit? Well, because they make their payments every month, right? And they're not over leveraged too much, but they've got a big mortgage. They've got great income. They've got good credit, but their debt ratios don't meet those guidelines. So they don't qualify to get more than $845,000 from the bank. So they have to go private. So now they got some debts and they want to consolidate them, right? So that they pay out those consumer debts, and eventually that'll help them to qualify for more with their income at the bank. That's the idea. So now they're looking at a refinance strategy. So we look at this and we go 65% of the value. That gives us a 35% buffer. Feel great about this. Good credit. They make all their payments. And we know this to be true about people's behavior. Usually the last thing that they don't pay is the mortgage, not the first thing. So if they're going to let something go, it's one of the other debts. So initially, when we look at this, we said, well, this makes sense. We'll consolidate those debts. And when we consolidate those debts, their debt ratios will come down. And within 12 months, they'll be able to go back to a bank and they will qualify. We can do the math. So we do the math. Looks great. We say, great. Let's just get an appraisal and make sure that the value is what you said the value is likely to be. Because when an application comes in, it comes in with an estimate, right? So the broker who's representing the borrower says, they think their house is worth 1.2 or 1.3 or 1.4 million. And then they owe 845 and they want 270. Add those two together, divide by the value, and you get the loan to value, which is 65%. In this case, we're looking at a fantastic opportunity. So we go out to get the appraisal and let's see what happens. So we verify everything, right? First mortgage is 845. We can get a statement for that. We can get a second mortgage statement showing it's 199, so that's real. We look at the income. We can verify the government income. We can verify the pension. We can look at the credit. We can see the scores, do all that. But then the appraisal comes in, and the estimate on the application was 1.7, and the appraisal comes in at 1.45. Well, that changes everything, right? Because now we're not 65% of the value where we feel all comfortable and cozy. We're now 75% of the value. So here's what we did. Let's look at the next slide. So now you've got a value of 1.45 million instead of a value of 1.7 million. So you're now at 77% loan to value. Now everything still works at 77%, except you don't have as many options to refinance at a bank at 77% as you did at 65. So that becomes the issue that we want to try to address. So here's what we did. We looked at it and we went, well, do we have to have these loans or these credit matters paid out? And the reality is we don't necessarily have to have them all paid out right now. The borrower could be paying them out over time if they don't need to make a payment to our mortgage. So rather than taking on those debts, I'd like to lend less. And instead of being at 77, I'd like to be at 75% because that opens up a number of doors. There's more lenders that will fund at 75% than there are that will fund at 80%. And I know that over the course of 12 months, if the borrowers are okay making a mortgage payment for $270,000, then they can take that money and start paying down their own debts. So I don't need to take those debts and secure them with the property. So I looked at the structure and said, well, what if we lent 250,000 instead of 270? So that brings our LTV down to 75%, where I'm more comfortable and there's more options for the exit. And then instead of taking out their debts, let's build an interest reserve so that they don't have a mortgage payment for this 270. And then for 12 months, they can focus on paying their own debts down. Now, why I like that is because it puts the onus on the borrower to support their own exit strategy. And if we get to month 8 or month 9 and they haven't done that, we'll know because we can look at the credit and see, but also they won't have as many options for refinance through a bank, and that's going to become a problem for them. Well, at that point, we're at 75% of the value. I know that there are other private lenders who would probably fund this mortgage, and there are B lenders that can take the mortgage on. So I still have outs, but if the borrower does not do what the borrower needs to do to support their own exit, then we call the loan and we force them into a situation where they either have to sell it or find another lender. And we wouldn't do an extension or a renewal. So this is a safer way to go. So for us, we looked at this, how can we restructure this amidst the idea that the value is not what we thought it was? The value is 1.45. Let's reduce the loan amount and limit our exposure to 75% of today's value. And then let's use the 250,000 differently. Let's make sure we eliminate payment risk. So now I know, remember our three pillars, right? Look at the collateral we did. It's 1.45 million. Ability to pay, we can eliminate that risk entirely by building an interest reserve that pays the payments the whole 12 months. And then exit strategy, we shift the onus to the borrower to do what they need to do with the money they were going to pay to us every month in interest. They can use that money to pay their own debts down, reduce their debt ratios, improve their refinance strategy, and hopefully move out to another bank. Now, it all worked, right? It all worked, but they didn't have the right guidance to get that refinance in place. So when we started talking to them at 9 months, they had done what they needed to do. They had reduced their debts. They had got themselves into a position to exit, but they didn't have the right representation in the broker channel to do that. And when we discovered that, instead of sitting back and saying, well, that's not our problem, that's your problem, we looked at it and said, well, how can we help? And so let's go to the next slide. There's the structure that made it work. Sorry, we probably should have put that slide up there while I was talking through the structure. But essentially, we gave the deal what it needed, and we got to a place where the borrower was able to refinance. Go to the next slide. Okay. So we get into a place where we can help this borrower, connect them to the right broker. They're able to go and refinance with another lender. The problem ended up being they couldn't get that mortgage in place in time to meet the maturity at 12 months. But because we knew that they were able to refinance, we were able to extend them just for an extra 30 days. And in that 30-day window is when they actually were able to refinance. Let's see the next slide. Is there another slide?
That's it.
That's it. Yeah. So I mean, the story of this deal is one where you're looking at the beginning, you're looking at one picture, the appraisal changes the picture entirely, and so you adjust the structure to make sure that you're still meeting those three criteria. Do we know what the collateral's worth? Can it set us free? Do we have a good enough buffer? 25% buffer is very good. So the collateral checks out. Ability to pay, well, there was two ways to look at this. At the beginning, we were going to take out the debts, and if you take out the debts, you take out the minimum payments every month, and those minimum payments, the sum of all those minimum payments, freed up enough money to make payments to our new mortgage. Instead, when the value came down, we decided instead, because we're not at 65% of the value anymore, we're at 75 now. I'm a little more concerned about my payment risk than I am their debts. And so let's reverse it. Let's build in a reserve so that our payment risk is eliminated and force them to take on the responsibility of reducing the debts, which they did. And then the key to this whole thing, to be honest, the key to not letting it drag was connecting them to a good broker at the right time so that broker could organize and arrange a refinance and reward them for the work that they did utilizing the money properly. So, this is a success story not just for us and our investors, but it's a success story for the borrower, right? They come into private, they're in there for 12 months, and they're back to the bank, and everybody wins. You guys have any comments, questions?
I have a question for you.
Yeah.
How often are you seeing like this in this case in this market? Obviously, values have been dropping, and at the very beginning, you said that this one dropped, and it dropped what 10% ish, I guess it was.
Yeah.
How often are you seeing that right now? Is it a common occurrence that I assume I would think that my house is worth X and it might come in at Y, right? So I think borrowers think that their house is worth more than it might be.
I think there's a difference between we got to be careful when we say, values dropped.
Mm,
And I said it a bunch of times in this video, and it's great that you pointed it out. Is the reality is that what the estimate is, and you just mentioned this,
yeah,
what the estimate is, if the estimate was 1.7, doesn't mean that the value dropped. It just means the value might never have been 1.7,
very
right?
true. Yep.
So people do have an inflated idea of what their properties are worth, and that's conditioning from the last 10 or 15 years where every time people looked up, their
Yeah.
house was increasing in value. So like
Yeah.
so many people have gotten used to thinking, well, last year my house was 1.2, it must be 1.3 this year, you know, and it's just not.
Absolutely.
It's just not
Yeah.
happening, and we're not necessarily um I don't think we're seeing as much depreciation year over year now that as we were seeing in 24 and 25,
Mm,
but there's still flattening, right? So
yep.
you're not seeing, housing values recovering to what they were in 2022.
Yeah.
Um, and I think that's troubling for people because I think there's a lot of people waiting for that help, right? Like
Yeah.
waiting for the recovery. Okay, well, my house will be worth, what it was 4 years ago soon. And I don't think it's going to be that soon. But this is the beauty of what we do. 1 year terms,
Yeah.
1 year terms are, I don't know how to stress it enough for our investors. It's like the secret sauce. Like lending money for 1 year at a time gives us a chance to reevaluate the value of the asset that's securing the loan every year. And you just don't see values dropping by 20 or 30% inside of 1 year. And then we get to reevaluate it next year and lend against next year's value next year. So I can't overstate that. Like it's so important. Yeah, I see an article recently come out that talked about, so alarmist because it said like, wow, values of in certain pockets have lost 25 or 30% since 2022. And I'm thinking to myself, yeah, I actually had somebody call me and say, what do you think of this? And I was like, well, this is this supports everything we do. I mean, it's 2026. So just take the number and divide by 4 years and you're talking about 7 or 8% per year. And if we're evaluating the value every year, our buffer is 20, 25, on average, as you know, 30%. We're safe. Like we're safe. We're even safe on properties, if we have to hold them the mortgage for 2 or 3 or 4 years, which as you know is very, very rare, but if something happens, we can still survive. Our that buffer can still, even in a depreciating market that loses 7, 8% every year for 3, 4 years, you're still break even. You're still good, you know? And as we know, it's not just depreciation that creates a problem for a private mortgage lender. You have to have depreciation plus default at the same time. And the depreciation has to be significant, like inside of 12 months. It has to be extreme. So, I mean, if you do a good job underwriting, if you do a good job evaluating collateral, as you know, right now we're using a lot of additional resources. So we're not just looking at third party appraisals, but we're looking at realtor opinions of value. I want to talk to a realtor who's in the area selling properties on that street, and find out what they think the property would sell for and compare that to the appraisal, which is done, professionally, but it's done by somebody who's coming to visit the house, could be from anywhere, doesn't necessarily know the nuances of that neighborhood from a sales perspective, and is just using comparable sales that have happened nearby with similar homes. But I mean, you look in Toronto, for example, you can go neighborhood to neighborhood, and there can be wild fluctuations on what the same type of property is worth based on its demand. So, you know, these are these are things we have to take into consideration. But swinging back to my point is when you evaluate properties every 12 months, you significantly insulate yourself against, dramatic problems.
1 year terms, secret sauce.
1 year terms is part of the
Mm.
secret sauce, no question. Yeah.
Yeah.
Yeah. And it's funny, borrowers and brokers oftentimes will ask us, can I get a 2 year term? I say, well, no, you can get a 1 year term with an opportunity to renew it, but it's better for you too, because as a borrower, you should be trying to get out of here as fast as possible. So you want that window to open at the end of 12 months so you can look at your options again, look at how things have changed, how things have improved, how things, may be different. And with any luck, maybe be able to find your way back. If you look at like um, our big five banks and you classify them as A level banks. And then you have trust companies and whatnot, and you classify them as B level banks. And then private, let's call it C. Everybody wants to go from C back to A. But if you can go from C to B, you're good. Go. Like you're saving money. So, if every year the window opens up and you can reevaluate as well as a borrower, you should be looking to go from C to B at the very least, and then go from B to A. It's better to do that than to stay in C for a second year and then go to A. If you do the math, it doesn't take a rocket scientist to figure out. It's just progression. So 1 year terms work for both sides, not just for us, but it's safer as an investor, as a lender.
And that's that.
And that's that. All right, so that's the end of this one. I don't know if you have any comments, definitely put them in below, and I'll address them. But hopefully everybody gets the idea here.
Until next time.
Happy lending.
Happy lending.